Welcome to Iron Financial. Here, we forge stronger portfolios by hammering through the market noise and stress testing for weakness. I'm your lead analyst. I live and breathe the numbers. And with me, as always, is our market skeptic. He's here to make sure we're dealing with solid steel, not just corporate hype. Today, we're putting BP on the anvil. They just dropped a quarterly report with a headline number that looks like an absolute train wreck, and yet, the market barely flinched. So we're going to figure out what's really going on. Are we looking at a solid core, or is this whole thing a rotten deal? Let's get into it.
And this is where it all starts. Look at that number. A loss of $3.4 billion. That's just for the fourth quarter of 2025. This one number dragged their entire full-year profit down to basically nothing, just $100 million. For a company of this size, that's not just a rounding error, it's a massive failure. A number this deep in the red, that's usually a five-alarm fire on Wall Street. It's the kind of thing that should send a stock into a complete tailspin.
Okay, I gotta jump in right there. A $3.4 billion loss? That isn't just a bad quarter. That's a flashing red light that something is seriously broken. Any other company on the planet would be getting absolutely hammered right now. So the question on the screen is the only one that matters. Why isn't the stock collapsing? What does Wall Street see that the rest of us are missing? Or, maybe a better question is, what are they deliberately ignoring? Because this just does not add up.
That's the exact mystery we're here to solve. And to get to the bottom of it, this is how we're going to do it. First, we're going to dissect this very confusing quarter. Then, we'll forge the foundation. That's the bull case. After that, we're going to go looking for the cracks, which is the bear case. We'll analyze their so-called rebuilding plan, and then, at the end, we deliver our final verdict. Let's get started. All right, let's get right into the fire. This quarter is really a tale of two completely different reports living in the same document. On one hand, you have the official, statutory numbers. These are the ones that have to follow all the strict accounting rules, and they look absolutely awful. But then, you've got the underlying or adjusted numbers. These are what the professional analysts and traders are laser focused on, and they tell a totally different story. To really understand this company, you have to be able to read both languages.
Whoa. Let's be real here. From a shareholder's point of view, there's only one report. The one that says, we lost billions of your dollars, and oh, by the way, we're stopping the buybacks you were counting on. You can talk about underlying this and adjusted that all day long, but a huge loss plus no buybacks, that just feels like a punch to the gut. That's not a story, that's a straight-up failure.
And this slide right here captures that exact disconnect you're talking about. The headline story. On the left, it's a horror show. Everything you just said. But the market story, on the right, that's what the pros are looking at. And on that side, their adjusted earnings per share actually beat estimates. Revenue wasn't just good, it smashed the consensus. Their adjusted operating profit was right where analysts expected it to be. The bottom line is, the market was already braced for a messy quarter, and on the metrics that traders actually care about, BP showed up.
Exactly. So if we're going to forge a real hard opinion on this thing, we've got to look past all that headline noise and inspect the actual foundation of the company. Is the core business solid? Is it generating enough cash to survive this storm and actually rebuild? The bull case says that underneath all the accounting mess and the strategic drama, the fundamental engine of BP is still an absolute powerhouse. Let's go look at the steel beams.
And here it is. This is the main support beam holding up the entire structure. $24.5 billion in operating cash flow for the year. Just think of this as the raw, cold, hard cash the company's main business operations spit out, before any of the accounting tricks or write-downs. This is the purest signal you can get of the company's core health, and it proves without a doubt that their primary business, pulling oil from the ground, refining it, selling it, is still a phenomenal cash-generating machine. This money pays for everything else.
So, what are they doing with all that cash? This slide tells you everything you need to know. They're reinforcing the walls, they're fortifying the balance sheet. Net debt is down to $22.2 billion. That's a reduction of $800 million from last year. Now, a company in real crisis, it takes on more debt. A company with a solid core, it pays it down. This isn't just a number, it's a strategic decision to de-risk the entire company and build a much more resilient financial structure. They're using their operational strength to build a fortress.
And look at this. This shows the core isn't just holding up. Some parts are absolutely on fire. Take a look at the customers and products division. This is your refining and marketing. Their underlying profit more than doubled in 1 year, from $2.5 billion in 2024 to $5.3 billion in 2025. This shows that management's focus on cutting costs and getting super efficient in their legacy business is paying off in a huge way. This isn't a company that's dying, it's a company that's optimizing its most profitable parts.
And to really hammer home the bull case, Listen to the CFO herself. The takeaway here is that this isn't chaos, it's a plan. They are methodically executing a strategy that's all about operational strength and financial discipline. The message they're sending is simple. Trust the process. We're building a solid foundation, even if the renovation project looks a little messy from the outside.
A plan? That sounds more like damage control. I'm sorry, but all this talk of a solid foundation is just corporate spin meant to distract us from the gigantic, multi-billion-dollar cracks that are showing up all over the place. You can't just wish away a $3.4 billion loss. That money came from somewhere. So let's stop admiring the blueprint and start looking at where this whole structure is actually failing.
Okay, let's start right here. This is the massive chasm between their two stories. On the left, you've got the analyst view, a nice tidy $7.5 billion in profit. But on the right, you have the harsh reality, just $0.1 billion. The gap between those two numbers is over $7 billion. So what exactly are they adjusting to make that gap disappear? That's not a rounding error, my friend. That's a black hole where they bury their bad decisions.
And this right here is the number one thing they're trying to hide in those adjustments, an impairment charge. Now don't let the fancy accounting term fool you for a second. An impairment is a public confession of a spectacular failure. It means the company spent billions of dollars buying things, projects, other companies, and is now telling you, the owner, that those things aren't worth what they paid. It is a direct write-down of a bad investment. It is vaporized capital.
So where did they waste all this money? This chart tells the whole ugly story. BP took $5.4 billion in impairments last year. And where did it come from? Almost all of it from the gas and low-carbon energy segment. We're talking $3.2 billion in write-downs in the fourth quarter alone. This isn't their core oil business. No, this is their shiny new transition businesses. Archaea Biogas, Lightsource BP Solar, their big offshore wind projects. This isn't just a crack in the foundation. This is their entire green energy strategy completely crumbled.
And here it is, the final nail in the coffin, the direct consequence for every single person who owns this stock. Why are the buybacks suspended? Simple. Because the cash that was supposed to go back into your pocket is now being used to patch up the holes in the balance sheet that were blown open by these failed green investments. This is the clearest signal you can possibly get that shareholders are now paying the price for management's terrible strategic bets. The deal they made with investors has been broken. Period.
Okay, those are all extremely valid points. The damage is definitely real, and you can't just ignore it. So the billion-dollar question becomes, what's the plan to fix it? Let's take a hard look at management's blueprint to repair this damage and try to rebuild the trust they've lost with investors.
All right, this is their blueprint for 2026, and what I see here is discipline. They're putting a tight cap on capital spending, which tells me they're not just going to throw good money after bad. And look at this. They expect $9 to $10 billion in divestment proceeds. That's cash from selling off assets, mostly from selling a piece of their very valuable Castrol business. They're planning to use that massive cash infusion to aggressively pay down their debt. To me, that sounds like a solid plan to strengthen the balance sheet fast.
I don't see a rebuilding plan. I see a patch-up job. What you call disciplined spending, I call no money for growth. And they basically admit it right there in their guidance for their main business. Production is going to be flat to slightly lower. And that major cash infusion, that's a one-time garage sale. They're selling one of their best assets to make the numbers look good for a year. What happens in 2027 when there's nothing left to sell? This isn't a strategy for growth, it's a strategy for survival.
And this slide right here proves my point. Just look at their new priorities. The dividend is safe. Okay, fine. But look at step 3, the promise to return 30 to 40% of their cash flow to investors through buybacks. It's officially retired. The deal has changed. The new number one priority is paying off the debt they racked up from their failed green adventures, not rewarding shareholders. The investor has officially been moved to the back of the line. Okay, we've laid out both sides of the argument. We have the bull case, a strong, cash-generating core that's being used to fortify the entire company. And we have the bear case, massive strategic failures, billions in destroyed value, and a broken promise to shareholders. It's time to put it all on the scales. We have to cut through all the noise and deliver the final, no-nonsense verdict from Iron Financial. Is this stock a structural opportunity, or is it a trap? So, let's just recap the core arguments we've been battling over. The bull case is built on that unshakable foundation. $24.5 billion in raw cash flow proves the core engine is just fine. They're using that cash to systematically pay down debt and build a stronger balance sheet, all while key parts of the business, like downstream, are knocking it out of the park. But the bear case, as our skeptic rightly pointed out, shows some very real, very deep cracks. You can't just ignore a $3.4 billion loss, billions wasted on a flawed green strategy, the suspension of buybacks, and a forecast that shows zero growth. And our verdict is in. Iron Financial sees this as a structural opportunity. Specifically, we see this as a turnaround play. Now, the cracks are severe, yes, but they're concentrated in one flawed part of the strategy, that rushed, poorly thought-out pivot into renewables. The impairments, they are a painful but absolutely necessary admission of that failure. And the crucial part is, management is now actively correcting that mistake. They are taking their medicine. The core oil and gas business is still a cash-printing machine, and they're now using that strength to build a leaner, tougher, more resilient company. The pain from these write-downs is a one-time hit, but the benefit of a stronger balance sheet and a much more focused strategy, that's going to pay off for years to come.
And that brings us to our final thought for today. What we're watching happen with BP, it might be more than just one company changing course. This could be a defining moment for the entire energy sector. The whole era of big oil just throwing billions of dollars at flashy renewable projects with fuzzy returns, that might be over. So the real question becomes, is BP's painful, disciplined pivot back to its core strengths, using that cash to get its financial house in order and reward shareholders? Is that the new blueprint for how big oil not only survives but thrives in this volatile world? That's the question every single energy investor should be asking themselves right now.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.